Richard Grace is Chief Currency Strategist at the Commonwealth Bank of Australia, and he joins us now. Richard, thanks very much indeed for coming along. Let's talk a little bit about the yen and its unbelievable strength. We've got that export data come in a bit earlier on, and that showed a 3.3% drop. It seems the yen is impervious to fundamentals.
Well, I think participants continue to be encouraged to the yen because of Japan's very strong current account surplus. And let's not forget that the current account surplus generates a natural yen inflow into the country as well. But if you've got Japanese interest rates at similar levels to US interest rates, but the US carries a current account deficit and Japan carries a large current account surplus, and we've had issues in funding markets over the last number of months, then participants are more likely to gravitate towards yen rather than the US dollar. Another reason why they may gravitate towards yen is if you look at the currency reserves of central banks as they report it to the IMF, they're significantly underweight yen. And with real interest rates in Japan higher than real interest rates in Europe and real interest rates in the US at that front end of the curve, then it's understandable why participants are gravitating towards and increasing their exposure in yen. Japanese yen only makes up 3.6% of total allocated foreign exchange reserves as reported by central banks to the IMF. So I think it's quite understandable why the yen continues to remain very strong.
Well, does it remain that way, and what does the Bank of Japan do? Do they come in and intervene? Because they've done that twice and it's singularly failed.
Yeah, well, they can continue to do that at intermediate times if they want to try and stem the yen's ascent. But I think that the yen is going to continue to remain strong and probably strengthen from this point in time, because the US have given very good guidance that interest rates are on hold for the next 2 years. And across the curve we continue to see US yields decline, and as I mentioned, they're declining relative to where Japanese yields are. So we've got a situation where the Japanese yen is likely to strengthen, driven by those additional flows that I mentioned as central bank currency reserve managers continue to intervene. But the Bank of Japan, to answer your question, could intervene again. I wouldn't be surprised if they did, but it would only slow rather than stop the yen's appreciation.
You got a target on the yen?
Look, we think it can go below its previous... Dollar yen can go below its previous low of 76.25. We're very close to those levels now. I wouldn't be surprised to see dollar yen get down to sort of 71, 72 before the end of the year. But our end period forecasts have it tracking around this sort of 76, 77, 78 level for quite a lengthy period of time. But of course it's going to trade around those particular levels that I mentioned, and probably with dollar yen going down lower in the short term rather than spike higher.
Richard, I want to just move to another currency, another country as well, the large current account surplus. Is that the reason why we're seeing Switzerland and Swiss franc just going up and up and up, and no matter what the Swiss National Bank tries, they can't stem that rise?
Yeah, that's right. I mean, I mentioned Japan's current account surplus. That's around 3.5% of GDP, but Switzerland's is at 14.5% of GDP. It's absolutely huge. And that is another reason why participants are gravitating towards the Swiss franc. If you take the same measure that I mentioned before about central bank reserves in the Swiss franc, it's much less than even the yen. It's 0.1% of total global foreign exchange reserves by central banks as they report that to the IMF. But look at the Swiss's net international investment position. It's equivalent to 144% of GDP. It's very much a safe haven type currency, given that when funding pressures arise, participants will gravitate towards these current account surplus countries' currencies. If you look at the official flow data as well, net FDI into Switzerland has increased for the last 3 consecutive quarters. It's up 20%. From where it was 3 quarters ago. There is capital flows going into Switzerland, encouraged by these Swiss fundamentals, and they're also somewhat discouraged by what they're seeing in the Eurozone and the US, and so flocking to Switzerland in order to increase reserves and increase investments in that particular country.
Richard, thanks so much for your time. Richard Grace there from Commonwealth Bank, joining us there from Sydney, just going through what's happening with these foreign exchanges.